If you were to walk onto the trading floor of any major investment bank today, Goldman Sachs, JP Morgan, or a high-frequency hedge fund in Greenwich, and ask the senior partners to name the most influential trader in history, the answer wouldn't be Warren Buffett or George Soros. It would be a man who has been dead for over 80 years. A man whose name still commands a whispered reverence, as if he were a phantom still haunting the ticker tapes. Jesse Livermore. To the modern world, Livermore is a titan, a trading deity whose face belongs on a Mount Rushmore of finance. He is celebrated as a prodigy with a near supernatural ability to sense the market's heartbeat. And his life is the ultimate rags-to-riches archetype, a boy who fled a dirt-poor Massachusetts farm with $5 in his pocket and transformed himself into a man who could move the entire United States economy with a single phone call. His aphorisms like, "The tape doesn't lie" or "markets are never wrong," opinions often are quoted as gospel by retail traders and institutional giants alike. Indeed, the legendary book Reminiscences of a Stock Operator, published in 1923, remains the Bible of Wall Street. Despite being a fictionalized account written by Edwin Lefebvre, it is a transparent mirror of Livermore's soul. To this day, Amazon data shows it consistently ranks as a top seller in finance, and it is an unwritten rite of passage. Newly minted Ivy League graduates entering the world of high finance are often handed a worn copy of Reminiscences and told to memorize its contents before they are even allowed to touch a terminal. But here is the unsettling truth that the legends often gloss over. The man immortalized in that book, the cool, calculated, and invincible boy Plunger, does not accurately reflect the dark, fractured reality of Jesse Livermore's actual existence. Today, we pull back the curtain on the celebrated myth to uncover a story not just of unmatched wealth, but of a haunting, lonely descent into madness. Reminiscences is undeniably a masterpiece of market psychology. I have personally returned to its pages 4 or 5 times, each time finding new layers of wisdom on the virtues of patience, the danger of tips, and the necessity of emotional detachment. It warns us against the sucker's play of overtrading and the folly of fighting the trend. However, the real Jesse Livermore was a man of extreme contradictions. While the myth portrays him as a master of the crowd, the historical reality shows a man who struggled to master himself. While the book depicts a steady climb to wisdom, the archives reveal a cycle of self-destruction. To understand the scale of his genius and his tragedy, we must look at the facts that history often simplifies. Livermore didn't just trade bonds and instruments. He was a predator in the pits of stocks and commodities, specifically wheat and cotton. He was a man who mastered the movements of the masses on the ticker tape, yet could never truly master the inner turmoil of his own mind. Tragically, Livermore's life was not a linear success story ending in a peaceful retirement. It was a violent saga of astronomical peaks and cavernous, soul-crushing valleys. He didn't just lose money occasionally. He declared bankruptcy 4 times, each time falling from a height that would have killed a lesser man. But while the professional book masterfully captures the principles of his financial success, it silently glosses over the devastating psychological price he paid behind the scenes. Behind the $100 million trades was a man battling clinical depression and a profound sense of isolation. Success, for Livermore, acted like a desert island. The more gold he piled up, the further he drifted from the rest of humanity. The somber culmination of this narrative arrived on a rainy November afternoon in 1940. At the age of 63, the man who had once been the richest individual trader in the world walked into the cloakroom of the Sherry Netherland Hotel in New York. He didn't have a ticker tape in his hand this time. He had a Colt automatic pistol. His suicide note, left for his 3rd wife, Harriet, was 8 pages of agony. It concluded with a sentence that shatters the invincible trader myth. "I am a failure. My life has been a failure." How could a man who once held the equivalent of $1,800,000,000 in today's currency believe he was a failure? Why did the great bear of Wall Street succumb to the very emotions he warned others to ignore? To answer that, we have to go back to the beginning, not to the legend, but to the boy. Understanding a titan like Livermore requires looking at every piece of the puzzle, and much like how we must piece together the daily fragments of the financial world to see the bigger picture, in the fast-paced world of 1920s New York, information was power, but it was also a flood. Livermore spent his life trying to filter the signal from the noise. In our modern era, that challenge hasn't changed. It has only accelerated. This brings us to an essential tool for those who, like Livermore, strive to stay ahead of the curve without drowning in the data. Now, as we move past the introduction, we are going to explore the chapters of Livermore's life that reminiscences left out. We will see the 1907 panic, where J.P. Morgan himself sent a messenger to Livermore, begging him to stop selling short to save the American economy. We will witness the 1929 crash, where, while people were jumping from windows in despair, Livermore was ushering his family into a secret office to tell them he had just made the greatest fortune in human history. But more importantly, we will examine the Livermore paradox. How can someone be so right about the world, yet so wrong about themselves? This is the story of Jesse Livermore. Not the legend you've read about, but the man the history books were too afraid to show you. To understand why a man with the world at his feet in 1940 could feel like a total failure, we must first look at the moment he became a god of finance. We must go back to the year the world broke, and Jesse Livermore was the only one who saw it coming. The winter of 1928 felt like an eternal spring for Wall Street. The Roaring Twenties were reaching a fever pitch, and Jesse Livermore, now a seasoned veteran of the pits, was riding the crest of a raging bull market. To the average observer, the stock market was a magical machine that only went up. It was the era of permanent prosperity. The higher the market climbed, propelled by an almost irrational exuberance, the more aggressively Livermore invested. At this dizzying peak, the very fabric of financial reality was stretching. Stocks that had historically traded at a conservative 8 to 12 times their earnings, the gold standard of valuation, were now commanding astronomical figures, exchanging hands at 40 to 60 times earnings. But Livermore wasn't just watching the numbers, he was watching the people. Millions of ordinary Americans, from shoeshiners to seamstresses, were entering the market in full force. They were borrowing money, often against their family homes or meager life savings, to chase the promise of quick riches. Leading this spectacular charge were the high-tech stocks of the era. Groundbreaking radio companies like RCA. RCA was the Nvidia of its day, a symbol of a future that seemed to have no ceiling. However, as the summer of 1929 unfurled, Livermore's finely honed instincts began to twitch. While the masses were drunk on euphoria, he began to see cracks in the plaster. He noticed that while the leaders like RCA were still hitting highs, the broader market was starting to fatigue. With a cold clinical precision, Livermore began to quietly liquidate his long positions. But he didn't just walk away with his profits, and he began meticulously compiling a kill list. He was looking for the pivot points, those psychological levels where a stock's trend would finally snap. Timing, as Livermore often said, was everything. In the early weeks of that summer, he cautiously initiated a few small short positions, tentative probes into the market's vulnerability. He was testing the water. When the market stubbornly continued its ascent, he didn't argue with the tape. He didn't let pride get in the way. He quickly covered his shorts, taking small, manageable losses. This was his legendary discipline in action. He was willing to admit an error when it was small, rather than let it become a catastrophe. By late summer, the music finally changed. The price action on the large chalkboard in his private office began to shift. The chalkboard boys, wearing their direct line headphones to the exchange, were marking down prices with increasing frequency. Livermore famously said he could read the chalkboard the way a conductor reads sheet music. To him, the symphony was nearing its final, discordant note. He orchestrated his colossal short position with paranoid secrecy. He knew that if Wall Street realized the Great Bear was selling, it would trigger a premature panic. To hide his tracks, He used over 100 different brokerage firms, scattering his orders like seeds in the wind. Then came Thursday, October 24th, 1929, Black Thursday. The storm that Livermore had been tracking for months finally struck with unimaginable fury. The market plummeted by 11% at the opening bell. RCA, the darling of the bull market, which had traded as high as $114 earlier that year, saw its value evaporate as the ticker tape struggled to keep up with the freefall. It was a vacuum of buyers. The carnage only intensified over the following weekend. On Black Monday, the Dow plunged by 12.8%. On Black Tuesday, it fell another 11.7%. In just a few agonizing days, the stock market hemorrhaged more than a third of its total value. An entire year's worth of gains was viciously wiped out in a matter of hours. While the nation stood in shock and investors were literally losing their minds on the streets of Manhattan, Jesse Livermore was achieving the greatest trading performance in human history. Over that single week of chaos, as the world around him crumbled, Jesse Livermore made an astounding $100 million. In today's purchasing power, and that is equivalent to approximately $1.8 billion. At that moment, Jesse Livermore wasn't just a trader. He was a titan who had conquered the most powerful market on earth. He was one of the richest men on the planet, standing alone at the peak of his professional life. But as he sat in his office, surrounded by the frantic noise of a dying bull market, he didn't feel like a hero. He felt a profound, hollow chill. Because, as he would soon discover, winning $100 million was the easy part. Living with the consequences was where the real struggle would begin. Jesse Livermore had just performed a financial miracle. While the rest of the world was watching their life savings evaporate in the cold October air of 1929, he had extracted $100 million from the wreckage. In the eyes of the public, and he was either a genius or a vulture, but inside the walls of his sprawling Long Island estate, Evermore, the atmosphere was not one of celebration, but of sheer, unadulterated terror. When Jesse finally left his Manhattan office after the grueling week of the crash, he didn't return as a conquering hero. He returned to a house that looked like it was being looted. Paintings had been ripped from the walls, the family's silver was gone, his wife's jewelry boxes sat empty. He found his wife, Dorothy, and their two sons, Jesse Jr. and Paul, huddled with the servants in the back of the house. The scene was surreal. Dorothy, consumed by the headlines of bankruptcies and suicides, had spent the week in a drunken fog of dread. She was certain that because the market had died, Jesse must have died with it. Yet she was preparing for the bailiffs to arrive and seize everything they owned. With a haunting calmness, Jesse sat her down and explained the reality. They weren't poor. They were richer than almost anyone in America. But for Dorothy, the relief was short-lived. The trauma of that week, combined with years of living in the shadow of a man who was married more to the ticker tape than to her, had already done its damage. The $100 million wasn't a safety net. It was a golden cage. The cracks in the Livermore family didn't start in 1929. They had been widening for years. In 1927, an event occurred that would forever shatter Dorothy's fragile sense of security. A notorious gang, led by Boston Billy, breached the high-security walls of their mansion. The family was held at gunpoint, and the robbers made off with over $100,000 in jewels, a staggering sum at the time. While Jesse treated the loss of jewelry as he would a bad trade, something to be calculated and moved past, Dorothy could not. The invasion of her home, the place that was supposed to protect her from the volatility of Jesse's world, broke something inside her. She retreated deeper into alcoholism, a crutch that would eventually become her primary companion. As the 1930s began, Jesse's professional life remained a whirlwind of high-stakes gambling, but his personal reputation was being dragged through the mud. The press, who once lauded him as the boy Plunger, now hungered for his downfall. The tabloids exploded when a Russian mistress, actress Nadia Krasnova, sued Livermore for $250,000 and alleging a breach of promise. For a man who prized secrecy above all else, who used 100 brokers to hide his trades, this public exposure was a different kind of bankruptcy. It was a bankruptcy of character. Jesse was a man who understood the logic of the market, but he was increasingly lost in the illogic of human emotion. By 1932, the marriage that had survived multiple bankruptcies could no longer survive the wealth. Jesse and Dorothy divorced. In the settlement, Dorothy walked away with the Santa Barbara estate and millions in cash, but she also walked away with a growing, violent resentment that was being fueled by the bottle. The Livermore curse reached its most horrifying peak on Thanksgiving Day in 1935. By this time, Jesse had married his third wife, Harriet Metz Noble, and a woman whose history was already clouded by the fact that all 4 of her previous husbands had committed suicide. It was an omen that Wall Street gossips whispered about in dark corners. While Jesse was trying to rebuild his life, Dorothy was losing hers to drink at the Santa Barbara estate. On that fateful Thanksgiving, a drunken, hysterical argument broke out between Dorothy and their 16-year-old son, Jesse Jr. In a moment of pure, alcohol-induced madness, Dorothy grabbed a gun and fired. The bullet struck Jesse Jr. near his spine. As the boy lay bleeding on the floor, Dorothy's screams of, "I've shot my boy!" echoed through the halls. Miraculously, Jesse Jr. survived, but the Great Bear's spirit did not. The man who could stay calm while losing millions in a day was decimated by the sight of his son in a hospital bed, and a victim of the very chaos Jesse had spent his life trying to outrun. This was the unspoken price of the 1929 win. The $100 million had provided every luxury imaginable: yachts, mansions, private rail cars. But it couldn't buy a single day of peace. Jesse began to lose his touch. The market was changing. The SEC was being formed, and the old ways of the Great Bear were being outlawed. Jesse Livermore was a man out of time. He was a 19th century gambler trapped in a 20th century regulated world, and he was a father trapped in a nightmare of his own making. The fortune was dwindling, not just because of the market, but because the man who once had supernatural foresight could no longer see a future for himself. To understand how a man could lose a family, but gain a fortune of $100 million, that we must travel back to a time before the skyscrapers of Manhattan, back to a dusty farm in Massachusetts, where the obsession with the numbers first took root in the mind of a quiet, extraordinary boy. Yet, Jesse Livermore's extraordinary journey had certainly not begun with such opulent surroundings. He was born in Shrewsbury, Massachusetts, in 1877, into a poor but diligently hard-working family. His early life was marked by hardship. His father tragically lost the family farm when Jesse was a small child, forcing the family to relocate to his grandparents' home while his father painstakingly saved to acquire another small farm, this time in Acton, Massachusetts. Jesse was described as an unusually quiet and bookish boy, possessing an almost prodigious intellect. He reputedly learned to read and write by the tender age of 3.5, a feat that hinted at his extraordinary mental capabilities. He excelled remarkably at mathematics in school, demonstrating an innate aptitude that allowed him to complete 3 years' worth of arithmetic schoolwork in just a single year. At the tender age of 14, Jesse, with his mother's understanding blessing, ran away from home. His father, in a bid to bolster the family's struggling finances, had taken him out of school so he could help toil on the family farm. His mother, however, recognized that Jesse was not destined for the grueling life of a farmer, seeing the flicker of a different future in her son. To give him a head start, she sent him on his way with all the money she had managed to save, a meager sum that amounted to around $5. According to his biographer, Livermore, with an astonishing swiftness that showcased his drive, repaid her with $1,000 less than a year later, and an amount equivalent to approximately $36,000 in today's money. He often remarked that the principle of paying off his debts was deeply ingrained in him from his very earliest days, a steadfast commitment he endeavored to uphold throughout his entire life, no matter the duration or the difficulty. But before he could pay back thousands, he first had to understand the language of the street, a language written in ink and chalk. Upon arriving in Boston, Livermore, with no clear direction, simply walked into every business he passed in search of work. Fortuitously, he stumbled into Payne Weber, a prominent Boston-based brokerage firm, where, by sheer chance, someone was out sick that day. Jesse, a complete novice to the world of finance, was asked if he could step in to assist. His role was that of a chalkboard boy. When prices, a constant stream of vital information, would clatter through to the office on the ticker tape machine, often called out by a customer or a clerk. The chalkboard boys would then, with practiced speed, transcribe these prices onto a large blackboard for all the customers to see, constantly updating them throughout the day. Livermore found himself immediately in his element at Payne Weber. He thrived on the lively atmosphere, relishing conversations with both the affluent customers and the seasoned brokers. He eagerly absorbed the big news about burgeoning companies and the daring exploits of big speculators. He listened intently to myriad theories on how fortunes were both made and lost, a sponge soaking up every scrap of financial lore. Yet, amidst this hubbub, Livermore soon became fascinated by a profound dissonance. The price movements he observed flickering across the ticker tape rarely seemed to reflect what the brokers, customers, or even the newspapers were espousing. More strikingly, he began to notice that the vast majority of stock traders seemed to act on impulse, almost randomly, and, perhaps most tellingly, almost all of them consistently lost money. Working tirelessly on the chalkboard, he became utterly captivated by the intricate, almost organic way market prices developed. He started to discern that prices often moved before any public news about a particular stock was released. A powerful intuition began to form within him. He felt there might be repeating patterns embedded within these numbers, an underlying order beneath the apparent chaos. Driven by this nascent theory, and he began meticulously keeping a notebook, filling it with his observations and evolving theories. He maintained detailed records, noting which of his ideas proved prescient and which, equally importantly, failed. It is claimed that he possessed an almost photographic memory, enabling him to memorize vast chunks of daily price data, which he would then diligently transcribe into his notebook at the end of each day, relentlessly digging through the data, searching for those elusive, recurring patterns in the ebb and flow of market prices. Initially, Livermore collected this data and meticulously noted down his market theories purely out of an insatiable intellectual curiosity about markets and their complex mechanics. He was equally intrigued by the psychology of the customers and brokers, fascinated by the ease with which they passed along tips and rumors, information that, more often than not, proved utterly unreliable. At this early stage, he genuinely believed that one needed to be immensely wealthy, much like the sophisticated customers at Payne Weber, to even participate meaningfully in financial markets. However, a few months into his tenure, during one of his lunch breaks, another chalkboard boy unwittingly introduced him to a far darker, less reputable but more accessible end of the industry, the bucket shops. A bucket shop was a curious, often illicit hybrid, a cross between a traditional brokerage house and a bookmaker. These establishments dealt in small, even single share stock orders, charging customers a slight premium over the prevailing price on the actual exchange. Boston, and at the time of Livermore's arrival, harbored numerous bucket shops, many of which were operated by shadowy figures connected to the city's burgeoning underworld. These establishments were the Wild West of finance, operating in a legal gray zone where the house always held the edge. For individuals with small accounts who couldn't meet the prohibitive minimum account sizes of the legitimate, larger brokerage firms, bucket shops were often their only gateway into the speculative thrill of the market. Crucially, these bucket shops didn't actually buy and sell shares on behalf of their customers, as legitimate brokerage firms did. Instead, they simply took bets on whether a stock's price would rise or fall. Customers were, in essence, gambling on price changes, and none of these trades were ever transmitted to the real exchange. And it felt deceptively like buying actual shares. but the prices at which these shares were notionally traded were based entirely on the ticker tape quotes, which were often manipulated or, at best, quite different from the real-time prices on the floor of the exchange. Bucket shops permitted their customers to trade with minuscule amounts of money, offering exorbitant levels of leverage. Customers often put up as little as 1% of the share's price, and the bucket shop would, almost invariably, take the other side of the bet. Traders would receive a betting shop-type slip, which could theoretically be cashed in at any time. The bet would remain active as long as the customer maintained enough margin in their account. However, if a customer bought using full margin and the stock price fell by a mere 1% or more, and the bet would be instantly wiped out, and the house would pocket the customer's money. Unsurprisingly, the house tended to win more than half the time, ensuring consistent profitability. It was a rigged game designed to devour the average man's savings, but the house hadn't accounted for a mathematical prodigy with a photographic memory. Beyond the inherent house advantage, there were also all sorts of underhanded tricks they could employ against their unsuspecting customers. If a bucket shop became aware that a significant number of their clients held positions in a particular stock, they would often discreetly enter a large sell trade on the actual exchange. This calculated maneuver would cause the price on the ticker tape, the sole reference point for their clients, to dip just enough to exhaust their clients' margins, liquidating their positions and seizing their funds. Such predatory activity would be unequivocally illegal today, but in that unregulated era, there were simply no rules against it. Intrigued by the raw, unfettered environment, Livermore decided to put his carefully developed trading ideas to the ultimate test at these bucket shops, eager to ascertain if his theories about price movements truly held water. At the remarkably young age of 15, he placed his very first trade, buying shares of Burlington Railway on margin for $5. He quickly sold them, making a lightning-fast return of 62% on his initial capital. At least, so the story is often told. Livermore was soon earning significantly more money trading than he was receiving from his meager wages at Payne Weber. With a decisive move, and he quit his job and plunged into full-time trading. By the age of 16, Livermore is reputed to have amassed more than $250,000 in today's money by expertly trading in Boston's bustling bucket shops. The bucket shops, by their very design, thrived because any individual who consistently won was swiftly and unceremoniously banned, leaving only the perennial losers who enjoyed the thrill of gambling and the rapid turnover of their capital. One by one, the bucket shops began to ban Livermore, exasperated by the consistent erosion of their profits due to his uncanny ability to win. In a desperate attempt to continue trading, he resorted to wearing disguises, but a 16-year-old boy making massive, impactful trades, even with a fake mustache, tends to attract unwanted attention. Around this time, and he earned the indelible nickname, the Boy Plunger, a moniker that would stick with him throughout his life, owing to his youthful appearance and the audacious size of his bets. Inevitably, he quickly found himself blacklisted from every single bucket shop in Boston. The sobering fact that many of these establishments were owned and operated by mobsters meant that his continued presence carried significant personal risk. It quickly became abundantly clear that it was time to move on. Livermore spent a period traveling to various bucket shops around the country, seeking new hunting grounds where his reputation had not yet preceded him. Finally, at the age of 20, he made the momentous decision to move to New York City, ready to take his shot at what he considered the biggest casino of all, the venerable New York Stock Exchange. As the train pulled into Grand Central Station in 1897, 20-year-old Jesse Livermore stepped onto the pavement of a city that was quickly becoming the financial heartbeat of the world. He had conquered the small-time gamblers of Boston, but New York was a different beast, a place that didn't just take your money, it broke your spirit. Livermore arrived in New York City in 1897, carrying with him a sizable stake for a man his age, though it had been recently diminished. He had suffered significant losses in the lead-up to his move, seeing his capital drop by approximately 75% from its peak, Notably, he didn't blame the markets or his trading counterparties for his financial setbacks. His unwavering belief was that the market was always right, and thus, he had simply been wrong. He often used to quip that a trader getting angry at the markets was like a gambler getting angry at a pack of cards. Instead of grumbling or assigning blame, he meticulously studied his mistakes, driven by the singular goal of learning from them and ultimately profiting from that hard-won knowledge. Upon his arrival in New York, he met his first wife, Nettie Jordan, and whom he would marry within a matter of weeks, a testament to his often impetuous nature outside of trading. While he was generally well-liked by the other traders in New York, less than a year into his foray on the exchange, he endured a punishing, prolonged streak of losses. This devastating period entirely wiped him out, leaving him not only penniless, but also owing money to his broker. In desperation, he asked his new wife to pawn some of the jewelry he had bought her over their whirlwind year together, hoping to use the funds to pay off his debts and restart his trading career. To his shock, she was having none of it. She flatly refused, took the jewelry, and walked out on him. Broken and alone, Livermore realized that the cold numbers on the ticker tape were far more predictable than the people he shared his life with. At this personal and financial catastrophe forced Livermore to take a significant period off, a painful sabbatical dedicated to deep reflection on his mistakes. He slowly, agonizingly, worked out a critical flaw in his methodology. His winning approach had worked flawlessly only in the controlled, often manipulated environment of the bucket shops, but it was failing horribly now that his trades were actually being executed on the exchange. There were several fundamental reasons for this stark difference. At the bucket shops, he could reliably buy and sell stocks at the precise price shown on the ticker tape, an instant, guaranteed execution. On the exchange, however, the market price had often already moved by the time his orders were filled, a phenomenon known as slippage. To compound matters, and his increasingly large trades were themselves causing the market price to move, both when he bought and when he sold stocks, creating an adverse feedback loop. Another major factor was that in the bucket shops, his losing trades had been automatically closed out when a stock price moved against him by a small percentage, effectively limiting his downside. But when he was trading actual stocks on the exchange, without such automatic safeguards, his losses could truly mount up, snowballing into catastrophic sums. Livermore now faced two monumental problems to solve. He desperately needed to devise an entirely new system for trading stocks, one that meticulously took these new, complex factors into account, and he needed enough capital to start trading again. With remarkable resilience, and he swallowed his pride and borrowed $1,000 from the very broker to whom he was already in debt. He then journeyed to St. Louis, seeking out bucket shops where he was not yet known. In just 4 days, he had been banned from every single bucket shop in St. Louis, but in that short, intense period, he had amassed enough money to pay off his debts and still had $3,800 in winnings to trade with. On his way back to New York, he discovered another bucket shop in Hoboken, where, before his identity could be recognized, he shrewdly managed to turn that $3,800 into a staggering $10,000. But this wasn't just about the money anymore. It was about funding a laboratory for a new kind of financial science. He returned to New York, and somewhat humbled but undeniably wiser, now fully prepared to rework his entire system. His goal was to develop an approach that could effectively handle the inherent slippage and market impact of trading actual stocks on the unforgiving New York Stock Exchange. Livermore spent months poring over the detailed notes he had kept on his trades, diligently studying them to gain a profound, intimate understanding of his past mistakes. He would later tell his sons that the only way you get a real education in life is through the torturous process of examining each and every one of your mistakes. Livermore ultimately concluded that the road to successful speculation was riddled with numerous pitfalls, and he candidly acknowledged that he would likely stumble into each and every one of them at some point. However, his new and more mature goal was to avoid repeating the same mistakes too often, an objective that, if achieved, could fundamentally alter his trajectory. His revised strategy dictated that he would need to trade far less frequently. The commissions and bid-ask spreads, he realized, had been steadily enriching his brokers while gradually grinding his own capital down to zero. With his new approach, he would aim to capture much bigger, more significant market moves, requiring greater patience and a longer-term perspective. He recognized that taking stock market tips had been a grave error, and that practice had to cease entirely. Why would anyone be offering him valuable tips, he reasoned, if they could simply trade on that information themselves and keep all of the profits? It was a logical fortress he had built around his mind, and yet even the strongest fortress has a back door. And for Livermore, that door was personal admiration. This realization instilled in him a new ethos of self-reliance. Not only would he no longer listen to other people's tips, but he also began keeping his own trades fiercely to himself. There was simply no benefit, he concluded, in divulging his actions to anyone. In Livermore's meticulously reworked system, he would first focus on discerning the general direction of the overall market before even contemplating individual stocks. His core objective would be to follow the line of least resistance, a powerful metaphor for aligning with the prevailing trend. There was, he realized, no point in stubbornly shorting the worst-performing stocks he could find if he fundamentally expected the overall market to rise. Why sail into the wind? He famously asked, emphasizing the futility of fighting the dominant market force. He now openly acknowledged that even with his refined system, he would often be wrong in his initial assessments, embracing error as an inherent part of the trading process, rather than a personal failing. Wrong in his initial assessments. He then systematically developed what he termed a probing approach to trading, a methodology rooted in observation and incremental action rather than rigid prediction. His strategy involved building positions slowly over time, allowing the market to reveal its true intentions. If a stock proved too easy to acquire, meaning he could buy a substantial amount without moving the price, it served as a clear signal that a formidable seller was likely lurking, making it a perilous entry point. Conversely, and if the market stubbornly refused to move in his anticipated direction, it wasn't a failure of his intellect, but merely an indication that his assessment was incorrect. The only rational response was to promptly close out his position and accept the small loss. On the other hand, a market moving decisively in his favor confirmed the validity of his initial judgment, prompting him to increase his position size, compounding his potential gains. This disciplined, iterative process, which prioritized adaptability over stubborn conviction, laid the groundwork for many foundational principles now incorporated into modern trend-following systems, methods still employed by traders today with varying degrees of success. By 1901, the American stock market was gripped by an unprecedented fervor and a true speculative frenzy, unlike any Livermore had witnessed before. However, the frenzy of 1901 brought a cruel paradox. During the infamous Northern Pacific corner in May, Livermore was fundamentally right about the market's direction, yet the sheer volume of trading caused the ticker tape to run nearly an hour late. By the time his sell orders were executed, the prices had cratered far below his expectations, wiping him out once again. It was a brutal lesson that being right is worthless if you cannot execute on time. In the years that followed, Livermore meticulously adhered to his evolving system, refining it through a rigorous process of self-examination and analytical dissection of his mistakes. This period marked a relatively tranquil and prosperous chapter in his life, and he engaged with the markets only when he perceived a clear edge, dedicating his considerable intellect to trading during those opportune moments and consciously stepping away to relax and enjoy his burgeoning wealth when market conditions offered no discernible advantage. This intentional detachment, this disciplined practice of taking time off when opportunities were scarce, became an integral and crucial component of his overall trading philosophy. By 1906, Jesse Livermore was no longer the broke kid from the bucket shops. He was a wealthy man with a proven system. But he was about to learn that sometimes the greatest opportunities come not from following the rules, but from a gut feeling that defies all logic. However, in 1906, Livermore famously and audaciously chose to disregard every one of his meticulously crafted rules, a transgression that, paradoxically, led him to amass an absolute fortune. He was enjoying a respite in Atlantic City that spring when an idle visit to a local brokerage house with a friend drew him back into the magnetic pull of the ticker tape. Observing the market's unusual strength, his system would have unequivocally advised buying stocks. Yet, for a reason he could never quite articulate, Livermore felt an inexplicable, visceral urge to go short. This highly speculative strategy involved selling borrowed shares in the hope of repurchasing them later at a lower price, thereby profiting from a market decline. It was a perilous gamble, inherently riskier than simply going long. He chose Union Pacific as his target, shorting the stock in April. When the trade immediately went against him, incurring losses, Livermore did the unthinkable. He doubled down, selling an even larger quantity of borrowed shares. By the close of that trading day, his short position had grown to such immense proportions that he felt compelled to cut short his vacation, rush back to New York, and personally oversee his relationship with his brokers, dedicating his full, undivided attention to the gargantuan, high-leverage trade, desperate to avoid being shaken out by any sudden market movements. As Livermore slept uneasily in New York, his colossal and deeply speculative position a stark violation of every principle he championed, the very ground beneath San Francisco began to tremble. The Great San Francisco Earthquake of 1906, a seismic cataclysm of immense power, sent tremors rippling across an astonishing expanse, felt from southern Oregon down to south of Los Angeles, and as far inland as central Nevada. The devastation was immediate and profound. Not only did countless buildings buckle and collapse, but fierce, uncontrollable fires erupted across San Francisco, raging for days and consuming vast swaths of the city. The disaster remains etched in American history as the deadliest earthquake the nation has ever endured. The following morning, news of the natural disaster barely registered on the stock market, which initially dropped by only a few points. A testament to the slow dissemination of information and perhaps a collective reluctance to grasp the full scale of the catastrophe. Livermore, with a daring born of desperation or genius, immediately approached his broker. He negotiated for even more margin and boldly doubled his already colossal short position. It took a full 2 days for the grim reality of the disaster to fully penetrate the market's consciousness. On the third day, the dam finally broke. The market reacted with savage force and collapsed. Union Pacific, already a heavily shorted stock, was among the hardest hit, plummeting dramatically. That single day, Livermore reaped a staggering profit of $250,000, an amount equivalent to approximately $8.5 million in today's currency. The true significance of such a narrative is profoundly difficult to parse. Livermore's legend is heavily intertwined with his systematic approach to trading and his unwavering commitment to rational decision-making. Yet, and here was one of the most spectacular successes of his entire career, a victory that appears to have been predicated entirely on sheer luck and an almost irrational degree of risk-taking. This extraordinary episode vividly underscores the perennial challenge of accurately evaluating a trader's skill, of attempting to differentiate between the serendipitous confluence of events and genuinely insightful judgment. Livermore himself never claimed any prescience regarding the earthquake. Indeed, having consciously violated every one of his own carefully established rules for this particular trade, it is demonstrably clear that there was nothing replicable or systematic about it. Nevertheless, human nature gravitates towards such captivating tales, finding immense appeal in the archetype of a trader with almost supernatural instincts, and is seemingly blessed with a magic-like ability to foresee future events. The more sober, yet arguably more profound, takeaway from this particular incident is perhaps that, occasionally, a fortuitous stroke of luck can indeed propel one an extraordinarily long way. But Livermore knew that a career built on luck was a house built on sand. He needed to prove that his 1906 windfall wasn't just a seismic coincidence. Following this unprecedented win, Livermore moved to cover his massive short position near the market's low, only to reverse course and begin buying Union Pacific stock, intuiting that its dramatic fall had been an overreaction. His longtime friend, E.F. Hutton, through whose esteemed firm Livermore often brokered his trades, observed the sudden influx of Livermore's buy orders. Concerned, and Hutton promptly called Livermore to discreetly warn him that the powerful pool, an informal syndicate of wealthy investors who secretly worked together to manipulate specific stocks, that dominated Union Pacific's trading, was deliberately allowing Livermore to buy, fully aware that more negative news was imminent. Livermore, ever the pragmatist, thanked Hutton for the valuable, if unsettling, information and immediately liquidated all the Union Pacific stock he had just acquired. The very next day, Union Pacific announced a significant 10% dividend cut, sending the stock plummeting further. Despite losing out on an immediate profit by selling, Livermore harbored no anger or resentment towards Hutton. Instead, he absorbed the experience as another crucial lesson in his ongoing education and a stark reminder of the perils of acting on unverified tips, no matter how well-intentioned. He had listened to external advice, and it had cost him. This expensive silence taught him a final, ironclad rule. In the world of speculation, the only voice worth listening to was the cold, rhythmic ticking of the market itself. With that valuable, if costly, lesson assimilated, Livermore embarked on a well-deserved vacation, first to the sun-drenched shores of Palm Beach, then to the sophisticated boulevards of Paris. He did not return to New York until 1907. Upon his return, he astutely observed widespread weakness festering within the market's fabric, and, drawing upon his refined system, began systematically selling stocks short once again, positioning himself presciently just ahead of the devastating panic of 1907. And the panic of 1907 materialized as a severe economic collapse precipitated by a confluence of critical events, notably including the lingering aftershocks of the San Francisco earthquake a year prior. The immense reconstruction efforts undertaken in San Francisco had triggered a significant outflow of gold from the United States. This presented a profound problem at a time when the dollar's value was directly pegged to gold, leading to a drastic contraction in the nation's money supply. The prevailing U.S. banking system of the era, weak and notoriously fragmented, proved utterly ill-equipped to handle such a shock. Compounding this fragility were years of excessive speculation and an unchecked overexpansion of credit in both the stock and real estate markets, which together had created an environment perilously ripe for instability. At the immediate trigger was a failed attempt by a group of prominent speculators to corner the market on the stock of the United Copper Company. This debacle sparked a chain reaction of public fear, leading to widespread bank runs, which then culminated dramatically in the collapse of the prestigious Knickerbocker Trust Company in October 1907. The financial system was in a state of near-total meltdown. Banks, drained of their reserves, were desperately hoarding what little cash remained. With no Federal Reserve in existence, there was no central lender of last resort to inject liquidity and staunch the bleeding. Brokerage firms were succumbing to bankruptcy in droves, and the only available money commanded exorbitant interest rates, ranging from 100% to an astonishing 150%. Amidst this unprecedented chaos, Livermore remained steadfast. He shorting stocks and rigorously adhering to his system, which dictated progressively increasing his short positions as the market continued its precipitous decline. The crisis was so profound that not only were banks and brokerage houses failing, but the very coffers of New York City itself were depleted. If the city couldn't quickly raise funds by November 1st, it faced imminent insolvency. As the market plunged, Livermore recorded his most profitable trading day yet, earning an astounding $1 million in a single 24-hour period, roughly $33 million in contemporary value. As the panic of 1907 tore through Wall Street, bringing the nation's financial system To the brink of total meltdown, Livermore was relentlessly shorting the market. He netted an astounding $1 million in a single 24-hour period, an equivalent to roughly $33 million today. The crisis reached such a critical point that J.P. Morgan, the titan of finance, who was personally bailing out the beleaguered U.S. banking system, had to step in. The situation became so dire that J.P. Morgan, working feverishly to prevent a total systemic collapse, sent word through intermediaries to the market's biggest bears. The message reached Livermore. For the sake of the national economy, he was asked to stop selling short. Recognizing that if the market died, his profits would be worthless anyway, Livermore agreed. Recognizing Morgan's unparalleled influence and the sheer gravity of the situation, Livermore promptly agreed. He immediately covered his massive short positions and began buying. This dramatic pivot provided crucial support to the faltering markets, at signaling other major investors to follow suit and ultimately helping to stabilize the financial panic. "What a life," he reportedly later recounted to his sons. "Broke 3 times before the age of 30, and then, at 31, sharing power with J.P. Morgan for a day." His early smaller-scale forays, taking a few points from stocks in the illicit bucket shops, had provided the initial capital and crucial learning experiences. However, it was the strategic mastery of catching these big waves, the major market trends and collapses, that had truly forged his immense fortune. This period marked Livermore's full immersion into the high life. He acquired the Anita Venetian, a magnificent 200-foot steam yacht, which he frequently moored in Palm Beach. For land travel, he boasted his own luxuriously outfitted private railcar, and his New York residence was an exquisite apartment on Riverside Drive, and he maintained a permanent suite of rooms at the iconic Breakers Hotel in Palm Beach. There, he cultivated a lifelong friendship with Edward Bradley, the notorious gambler who owned Bradley's Beach Club, an illegal casino that famously operated as the longest-running establishment of its kind in U.S. history. Livermore, known for his love of beautiful women, often found his romantic escapades, frequently involving dancers from the Ziegfeld Follies and other Broadway shows, splashed across the pages of society newspapers, feeding the public's fascination with his flamboyant lifestyle. In the wake of his 1907 triumph, Jesse Livermore believed he was invincible. He had shared power with J.P. Morgan and conquered the stock market. But now, he was about to turn his attention to a new, more volatile battlefield, the commodities pits, where a single charismatic voice would lead him to the greatest betrayal of his life. In 1908, Livermore broadened his trading horizons, venturing into commodities, beginning with wheat and oats. He famously asserted that he possessed absolutely no knowledge of agriculture or farming. His trading decisions in this new arena, guided purely by price action, a testament to his unwavering faith in the market's own narrative. On 2 separate occasions, Livermore engineered a corner in the Chicago cotton market. The first instance arose after he observed his peer, Percy, the Cotton King Thomas, fail spectacularly in a similar attempt, leading to his bankruptcy. The forced liquidation of Thomas's massive positions sent cotton prices plummeting, creating a rare opportunity. Livermore, seizing the moment, aggressively bought 120,000 bales of cotton. And while his substantial buying initially pushed prices back up from their lows, he soon found himself holding an enormous and rather illiquid position, recognizing that any attempt to exit would inevitably depress the price against him. To facilitate his exit, he employed a tactic now deemed illegal: painting the tape. Day after day, just as the Chicago market was closing, he would place massive buy orders, ensuring that artificially high closing prices were printed on the ticker tape and subsequently reported in the daily newspapers. His calculated gamble was that these seemingly robust closing prices in Chicago would entice buyers in London and other markets, sparking a broader buying frenzy among speculators. And his ultimate objective was to strategically unload his vast position into the very speculative fever he himself had masterfully engineered. As the price of cotton climbed higher and higher under his influence, the New York World newspaper sensationally declared in a bold headline, July Cotton Cornered by Livermore. Though he later denied leaking the story to the press, the article had its intended effect, causing cotton prices to soar immediately upon the market's opening the following day, enabling Livermore to exit his entire position at a very substantial profit. After achieving considerable success in commodity trading, a twist of fate found Livermore sitting next to Percy Thomas, the recently bankrupt Cotton King, at Bradley's Beach Club in Palm Beach. The two men, despite their contrasting fortunes, quickly became fast friends, and over time, Thomas, drawing upon his vast experience, began to illuminate the intricate workings of the commodities market for Livermore. He eventually convinced Livermore to join him in a long trade based on exclusive crop information that Thomas had meticulously gathered through a clandestine network of spies who provided him with detailed reports on crop conditions. Thomas imparted to Livermore virtually everything there was to know about cotton, its historical cycles, the identities of the major planters, and the specific cotton mills that purchased the raw crop for processing. While Livermore was intellectually fascinated by the complexities of this information, he remained profoundly skeptical of its practical trading value. In his view, such circulating information was largely useless, and as it would already be reflected in current market prices. True market movements, he believed, were driven by forward-looking information that even seasoned experts could not reliably ascertain. He maintained that all the essential knowledge one needed was inherently embedded within the price data itself, rendering news reports largely valueless and, quite possibly, a form of carefully crafted misinformation designed to mislead unsuspecting traders. Thomas, however, was renowned as a compelling orator, and it wasn't long before Livermore, against his deepest convictions, found himself falling under the older man's persuasive spell. He rationalized that Thomas's track record of being more often right than wrong suggested there might be a valuable dimension missing from his own pure price action style of trading, and despite his most fundamental instincts screaming caution, warning him to go the other way, Livermore ultimately agreed to join Thomas in the trade. No sooner had the pair bought their substantial cotton positions than the price began a disheartening and relentless sink. Instead of cutting his losses swiftly, as his own disciplined system vehemently instructed, Livermore, in a desperate and uncharacteristic move, attempted to prop up the falling price by buying even more. This ill-fated venture resulted in a catastrophic loss, wiping out 90% of his fortune and leaving him with a mere $300,000 when he finally walked away from the debacle. This traumatic episode was seared into Livermore's memory, forming an indelible lesson that profoundly influenced his future conduct. It explains why, in later life, and he would steadfastly refuse to discuss market matters with friends, politely but firmly asking people to keep their trades and any tips strictly to themselves. He recognized the insidious danger of external influence on independent judgment. Bernard Baruch, another titan of the era known as the Lone Wolf of Wall Street, for his fiercely independent approach, espoused a remarkably similar policy. He was famously quoted as requesting of his friends and brokers, "Please don't tell me anything that's happening to a stock I'm invested in. I don't want my judgment affected by anything you might say." In the devastating aftermath of these colossal losses, Livermore was forced to liquidate his most cherished symbols of success, his opulent yacht and his magnificent New York apartment. Desperate for capital, he plunged back into the markets with a frantic intensity, trading furiously in a futile attempt to force the market to instantly recoup his losses. This desperate revenge trading strategy proved catastrophic, leading him to completely wipe himself out and accumulate a staggering $1 million in debt to his brokers. The weight of this monumental failure triggered a complete emotional breakdown, plunging him into a deep depression. The more he meticulously reviewed his disastrous trades, the more profound his self-disgust became. It was 1910, and he entered the new decade a man undeniably wiser from his harrowing experiences, but financially ruined. The hope of forcing the stock market to pay your bills, Livermore reportedly later confessed to his son, is one of the most prolific sources of loss on Wall Street, And he had learned the hard way that the market is not a bank where you can withdraw money at will. It is an ocean that cares nothing for your debts or your desperation. Over the next few years, Livermore found himself a pariah, reduced to seeking credit from various brokers, some of whom, perhaps still swayed by his past legend or his persuasive charm, cautiously extended him a line of credit. Yet, his trading continued to be plagued by misfortune. He felt an overwhelming burden from his crushing debts, believing that his mind, usually so sharp and analytical, could not think clearly under the immense psychological weight of his financial obligations. Finally, in an act of surrender, he filed for bankruptcy protection towards the end of 1914, a year marked by the outbreak of war in Europe, and which ironically led to the temporary closure of the stock market. Before filing, Livermore, demonstrating a surprising degree of integrity, is said to have personally visited each of his creditors, explaining his dire situation and solemnly promising that he would, one day, repay every penny if he ever could. Remarkably, many of these creditors, perhaps touched by his honesty or retaining faith in his eventual recovery, reportedly refused to file their debts or claims with the bankruptcy court, though the full veracity of this anecdote remains debated. When the markets eventually reopened, and with his remaining debts legally discharged by the courts, Livermore, now unburdened, cautiously resumed trading, albeit initially in much smaller sizes than before, but this time with renewed discipline and a nascent return to success. By 1917, a triumphant Livermore made what he described as one of his proudest walks down Wall Street. He systematically stopped at the offices of each and every one of his former creditors, meticulously paying off all his bankruptcy debts in full. Then, 40 years old, Livermore, having endured the crucible of repeated financial ruin and redemption, resolved to implement significant changes to how he managed his life and wealth. Once he had rebuilt a substantial portion of his fortune, he prudently locked away $500,000 into an unassailable trust fund, from which he could only receive interest income, but was irrevocably barred from ever touching the principal. This financial fortress was not just for his protection, but a direct result of his 1918 marriage to Dorothy Went, and he wanted to ensure that no matter how hard he gambled on the floor, the walls of his home would never crumble again. It was the ultimate insurance policy against his own impulsive genius. Having cleared his debts and reclaimed his honor in 1917, Jesse Livermore felt he had finally mastered the game of survival. Now, he wanted more than just survival. He wanted a dynasty. But in his pursuit of a perfect family life, he would meet the woman who would become both his greatest muse and his most expensive liability. By 1917, at the age of 40, Jesse Livermore was no longer the impulsive boy Plunger of the bucket shops. He was a refined, methodical titan who had survived the crucible of 3 bankruptcies. He had just performed the most honorable walk on Wall Street, paying back every creditor from his 1914 failure. He was wealthy, respected, and for the first time in his life, profoundly lonely. It was in this transformative period that his path intersected with Dorothy Went. She was a Ziegfeld girl, introduced to him by the legendary impresario Florenz Ziegfeld himself. In the 1920s, being a Ziegfeld Follies dancer was the pinnacle of American glamour, a spectacle of ostrich feathers, elaborate staircases, and silent, statuesque beauty that captivated a nation before the era of the internet. Livermore was smitten, and his first marriage to Nettie Jordan had been a hollow shell for 18 years. They had lived apart almost since the beginning. With the same decisiveness he used in a market rally, Jesse finalized a divorce from Nettie, granting her every financial demand she made. He didn't care about the cost. He believed he could always make it back from the tape. In 1918, the 41-year-old Livermore married the 18-year-old Dorothy. He wasn't just buying a wife, he was buying a future. The early 1920s were the happiest years of Livermore's life. He was a father now. Jesse Jr. was born in 1919, followed by Paul in 1922. To house his growing dynasty, he acquired a magnificent 13-acre estate on Long Island Sound called Evermore, This wasn't just a house. It was a 29-room statement of absolute victory. The estate required a small army of staff to maintain, and among them was a full-time live-in barber whose sole job was to provide Jesse with a fresh shave and a haircut every single morning. While Dorothy filled the mansion with priceless European antiques and Persian rugs, Jesse built a private firing range and a sporting clays course. His collection of firearms eventually grew to over 400 pieces, a hobby that provided a rare escape from the flickering numbers of the stock exchange. Every morning, a chauffeur-driven Rolls-Royce would wait at the front gates. The journey to Manhattan was a masterclass in the power of wealth. His chauffeur famously greased the palms of the traffic signal operators along the route. In an era when traffic lights were manually operated, the sight of Livermore's distinctive Rolls-Royce triggered an immediate green light all the way to Wall Street. In 1923, the Livermore legend was etched into stone with the publication of Reminiscences of a Stock Operator. Though written by Edwin Lefebvre as a fictionalized biography of Lawrence Livingston, everyone on the street knew it was Jesse. The book turned him into a folk hero. He was the man who had cracked the code, the lone wolf who didn't need a bank or a board of directors to win. Inside the mansion, Dorothy was the life of the Roaring Twenties. Despite the strict laws of prohibition, the alcohol flowed freely at Evermore. Dorothy enlisted staff to brew beer in the basement, and she would lead a convoy of Rolls-Royces to deliver the illicit brew to their wealthy neighbors. To the outside world, they were the ultimate power couple, the king of speculation and the queen of high society. But even in this gilded era, the unexpected that Livermore so often warned about in his trading began to manifest in his life. Wealth of this magnitude acted as a lightning rod for the desperate. In 1925, a chilling plot to kidnap his young sons was narrowly foiled by the police. The realization that his success had put a target on his children's backs shattered Jesse's peace of mind. Then, in 1927, the nightmare became real. A notorious criminal known as Boston Billy, allegedly aided by a disgruntled former employee, invaded the mansion. At gunpoint, the family and their guests watched as the burglars stripped Dorothy of nearly $100,000 in jewelry. While Dorothy displayed an unnerving composure during the robbery, even negotiating with the thieves to leave her favorite pieces so as not to wake the children, the aftermath was devastating. And the trauma didn't leave her. It simply changed its form. Her social drinking transformed into a desperate dependency on the bottle. Jesse, meanwhile, retreated further into his work and his infidelities. He maintained a string of apartments across New York for his mistresses, actresses, and showgirls who provided a temporary distraction from the growing silence between him and Dorothy. As the decade drew to a close, Jesse Livermore was at the peak of his financial powers. He was worth millions, his system was fine-tuned, and his reputation was untouchable. He had built a fortress of stone and gold to protect his family from the world. But as he sat in his private office, watching the irrational exuberance of 1928 and 1929, he knew something that Dorothy didn't. He knew that every bull market ends in a crash, and he didn't yet realize that the coming crash of 1929 would not only destroy the American economy, but would act as the final, violent catalyst that would tear his gilded cage apart. The stage was set. Jesse Livermore was about to make his greatest fortune, and in doing so, he would lose the very family he had built the fortress to protect. By the dawn of 1930, Jesse Livermore was a man who had technically conquered the world. While the smoke was still rising from the scorched earth of the 1929 Great Crash, Livermore sat atop a mountain of cash totaling $100 million. In a nation where families were suddenly lining up for bread, Jesse Livermore was worth the modern equivalent of $1.8 billion. But wealth of this magnitude, acquired during a time of national agony, carried a toxic radiation. And to the American public, Livermore was no longer the boy Plunger hero. He was a financial vampire. He received death threats daily. He had to hire bodyguards to walk his children to school. The gilded cage he had built on Long Island, the 29-room mansion known as Evermore, was no longer a sanctuary. It was a fortress under siege by public hatred and internal rot. As Jesse retreated into the cold clinical silence of his Manhattan office to manage his fortune, the atmosphere at Evermore descended into a surrealist nightmare. Dorothy Wendt, once the vibrant queen of the Ziegfeld Follies, was drowning. The trauma of the 1927 Boston Billy robbery, where she had stood at gunpoint, had left a permanent scar on her psyche. She sought solace in the only place she knew, the bottle. Her alcoholism, fueled by Jesse's blatant and constant infidelities with Broadway showgirls, manifested in increasingly erratic behavior. In one legendary fit of impulsivity, Dorothy fired her entire domestic staff, dozens of specialized workers, and replaced them overnight with a crew of French citizens who spoke not a word of English. Her stated goal was to force her sons, Jesse Jr. and Paul, to become fluent in French by sheer necessity. The house fell into chaos. Neither Jesse nor Dorothy could communicate basic instructions to the kitchen or the stables. Within a week, the French staff was dismissed, and a new crew was rotated in. In another bizarre episode of alcohol-induced whim, Dorothy became convinced that the family needed purity to survive the Depression, and she purchased a prize-winning cow and insisted it be brought into the mansion's formal living areas so that Jesse could have fresh from the source milk for his morning coffee. The image of a cow grazing on a $1 million Persian rug while servants in tuxedos looked on in horror became a symbol of the Livermore family's detachment from reality. While Dorothy spiraled into madness, Jesse provided no anchor. He was a ghost father, more present on the ticker tape than in the nursery. His parenting philosophy was as reckless as a high-leverage trade. He famously told his sons that they didn't need to excel in school or even learn the finer points of literacy, because men of their stature would simply hire secretaries to handle the details. Jesse Jr. and Paul grew up in a vacuum of discipline, surrounded by 400 firearms, private yachts, and the knowledge that money could solve any problem. But money couldn't solve the Livermore curse. Jesse's blatant string of mistresses, actresses like Nadia Krasnova, who eventually sued him for $250,000, ensured that Dorothy's drinking was never just a habit. It was a weapon she used against herself to punish him. By 1932, the friction between the king of speculation and the queen of the follies reached the breaking point. Dorothy filed for a quick divorce. In a move that shocked even the most jaded Wall Street lawyers, Jesse granted her a massive settlement, a $4 million settlement, roughly $85 million in today's value, in cash, plus the deed to Evermore and full custody of the boys. It was a total liquidation of his domestic life. Just months after the ink dried, Jesse married his third wife, Harriet Metz Noble. The marriage was the talk of the town, but for all the wrong reasons. Harriet was a 4-time widow, and the street whispered that all 4 of her previous husbands had died by their own hand. To the superstitious traders of Faux Wall, Harriet was the Black Widow of finance. Jesse, the man who prided himself on reading the signs of the market, ignored the most glaring red flag of his life. Dorothy moved to California with her new husband, ironically, a federal prohibition agent, and the 2 boys, effectively abandoning the Long Island estate. However, she treated the 29-room mansion not as a piece of history, but as a playground for her whims. During her infrequent return trips to New York, she allowed a pack of unruly hunting dogs to live inside the house. The animals, all left to their own devices, shredded 18th-century tapestries and gnawed on the legs of Chippendale chairs that were considered national treasures. The final, most absurd act of neglect came when the waterfront side of the mansion began to subtly tilt due to soil erosion. Rather than hiring engineers to stabilize the foundation, Dorothy came up with a solution that defied logic. She ordered her butler to take a handsaw and cut 2 inches off the legs of every piece of furniture on the south side of the rooms so they would sit level on the slanting floors. This act of vandalism destroyed one of the finest assemblages of European antiques in the Western Hemisphere. Dorothy's total lack of fiscal responsibility eventually collided with the harsh reality of the Great Depression. Despite her $4 million settlement, and she simply refused to pay the property taxes on the Livermore estate. She believed the rules of the common man didn't apply to the Livermores. In a humiliating public spectacle, the state of New York seized the property and everything inside it. Her Rolls-Royce limousines, the hand-sawn antiques, and the once mighty fortress were put on the auction block. In the bleak economic climate of the mid-1930s, the estate, valued at $3,500,000, was sold off piecemeal for a measly $250,000. Dorothy had squandered one of the greatest divorce settlements in history in less than 3 years. As the physical walls of his empire crumbled, Jesse Livermore was entering the final, darkest chapter of his life, and the man who had survived the panics of 1907 and 1929 was about to find out that the most dangerous market of all wasn't the New York Stock Exchange. It was the volatile, unhedged emotions of his own family. On Thanksgiving Day, 1935, the Livermore curse would finally draw blood. While the physical foundations of Evermore were sinking into the Long Island soil, the legal foundations of Jesse Livermore's world were about to be dismantled by a force even more powerful than a market crash: the United States government. Meanwhile, a new era of financial regulation was dawning. On May 30th, 1933, Congress passed the landmark Securities and Exchange Act, leading to the formation of the Securities and Exchange Commission, SEC, a year later, in 1934. These new regulations effectively outlawed many of the aggressive, often manipulative tactics Livermore had famously employed to amass his fortune in the markets. Yet, the immense psychological weight of the markets was secretly tearing him apart. In December 1933, the legendary speculator mysteriously vanished. For 26 grueling hours, a frantic police search ensued across New York City for one of the world's wealthiest men. He finally stumbled back to his apartment, pale, dazed, and his mind completely blank. He only realized he was missing after reading the newspaper headlines slipped under his door. Doctors delivered a chilling diagnosis: an amnesia nervous breakdown. His mind had simply shattered under the pressure. This terrifying mental collapse signaled the end of his golden era. Unable to regain his legendary trading instincts, his $100 million fortune completely evaporated, forcing him to file for his final, devastating bankruptcy in 1934. But for Livermore, the loss of his millions was merely a prelude to a far more visceral destruction, one that wouldn't happen on a ticker tape, but within the walls of his own home. The domestic tension reached a horrific breaking point on Thanksgiving Day, 1935. In a fog of mutual resentment and heavy intoxication at their California home, a heated argument between Dorothy and their 16-year-old son, Jesse Jr., escalated beyond repair. A single, yet deafening shot suddenly shattered the holiday silence. Guests rushed in to find a tragedy that no amount of wealth could undo. Jesse Jr. lay critically wounded. Miraculously, the boy survived the physical trauma. But for Jesse Livermore, this was the ultimate collapse, not of a stock price, but of his own flesh and blood. The scandal became the final nail in the coffin of his spirit, leaving the Great Bear a hollow shell of the titan he once was. The scandal was the final nail in the coffin of his public reputation. The Great Bear was now a tragic figure in a tabloid drama, a man whose professional genius could not safeguard his private life from ruin. Jesse Livermore never managed to reclaim his legendary fortune. His once masterful trading strategies, it seemed, had become obsolete, rendered ineffective by changing market dynamics and new regulations. Deeply depressed, he reportedly showed little interest in anything, living perhaps off the income from a trust fund he had discreetly established years earlier, or perhaps on his wife's considerable wealth. In 1940, he published How to Trade in Stocks, a book that, tragically, sold poorly amidst a public still reeling from the Depression and largely disinterested in the stock market. By 1940, the ticker tape had stopped singing for Jesse Livermore. The physical and emotional scars of the last decade had left him standing on the edge of a precipice, waiting for the one final sign that his time was over. The final act of Jesse Livermore's life unfolded with a chilling premonition. In 1933, amidst his financial turmoil and a bitter divorce, Livermore married for the third and final time. Her name was Harriet Metz Noble, a wealthy 38-year-old singer and socialite. But Harriet brought with her a chilling, almost gothic history. Livermore was her fifth husband. Horrifyingly, all four of her previous husbands had reportedly died by suicide, including Warren Noble, who hanged himself following the 1929 stock market crash. To the press and the whispering elites, she was a walking omen, a woman carrying a dark Black Widow curse. By marrying her, the Great Bear of Wall Street had unknowingly stepped into a deeply ominous cycle, setting the perfect morbid stage for the final act of his life. And that chilling premonition finally materialized on November 27, 1940, when Livermore and Harriet were at the exclusive Stork Club in New York. When the house photographer approached, asking to take a picture, Livermore reportedly consented with an unnerving remark. "No problem. But it's the last photo you'll take of me. Tomorrow I'm going away for a long, long time." It was a final, cryptic sell order, not for a stock, but for his very existence. His wife reportedly appeared bewildered by the statement, unable to grasp its grim implications. The very next day, on Thanksgiving 1940, Livermore walked into the cloakroom of the elegant Sherry Netherland Hotel. He took a seat, raised a .32 caliber Colt automatic to his head, and pulled the trigger. He was 63 years old. Inside his pocket, and police found a leather-bound notebook containing an 8-page handwritten suicide note addressed to his wife. Its final words were haunting. "My dear Nina, can't help it. Things have been bad with me. I am tired of fighting. Can't carry on any longer. This is the only way out. I am unworthy of your love. I am a failure. I am truly sorry, but this is the only way out for me." For decades, a popular myth has circulated that the Great Bear of Wall Street died entirely broke and drowning in debt. This is historically false. While his trading empire had crumbled, Livermore had wisely secured his family's future years earlier with untouchable trusts. At the time of his death, though far from his peak of 100 million, Livermore was not the bankrupt pauper of urban legend. And thanks to the ironclad trusts he had established during his golden years, his estate still held significant wealth, providing his family a legacy worth millions in today's purchasing power. There is a profound lesson here in risk management. Despite his all-or-nothing gambling instinct, Livermore had the foresight to build an unassailable financial fortress. By locking away funds in untouchable trusts during his peak years, he ensured that even if he burned his professional account, his family's survival was hedged. He proved that every investor needs a safety floor, a portion of wealth that is legally and physically separated from the volatility of the arena. He lost his spirit, but he did not leave his family in the breadlines he once helped create. He didn't die of poverty. He died of a lifelong depression that no amount of money could cure. For a man who spent his life predicting the future of markets, he had become a prisoner of a past he could no longer outrun. This reveals the ultimate Livermore paradox. Jesse was a grandmaster of crowd psychology. He could decode the fear and greed of millions just by watching the rhythmic ticking of a ticker tape. Yet, he was utterly defenseless against his own personal psychology. He could master the market, but he could not master himself. His life serves as a stark reminder that in trading, technical skill is only half the battle. The other half is the war waged within your own mind. But wealth could not stop the dark curse that seemed to follow his bloodline. When his son, Jesse Jr., arrived at the hotel to identify his father's body, he collapsed to the floor in shock. And tragically, the cycle of despair would claim the next generations. Both Jesse Jr. and his own son, Jesse III, would also die by suicide decades later, sealing the tragic and chilling legacy of the Livermore family. The life of Jesse Livermore offers a wealth of lessons, both inspiring and cautionary. While many know his story primarily through the legendary, albeit partially fictionalized book, Reminiscences of a Stock Operator, Published in 1923, years before his ultimate peak and the devastating tragedies that would follow, Livermore indeed led a truly astonishing life. He transformed himself from a teenage runaway into one of the world's wealthiest men, entirely self-educated. His book, How to Trade in Stocks, remains in the public domain, offering invaluable insights into his approach to the markets. However, as a critical perspective is essential, one should never follow his rules blindly. With today's technology, his strategies can be easily backtested against historical market data. It's safe to assume that if Livermore were alive today, he certainly wouldn't be blindly adhering to someone else's rules, much less his own, in the way some enthusiasts still do. We must also distinguish between the markets of 1929 and the markets of today. Livermore operated in the Wild West of Wall Street, an era before the SEC, where painting the tape and naked manipulation were the tools of the trade. Today's markets are governed by high-frequency algorithms and strict transparency. While the price action patterns Livermore discovered are timeless, because human fear and greed are timeless, the environment has changed. If Livermore were trading today, and he would likely be a pioneer of quantitative analysis, constantly adapting his system to stay ahead of the machines. While he accumulated immense wealth at various times, he also demonstrated an uncanny ability to lose it just as quickly. Intriguingly, some of his greatest successes often occurred precisely when he deviated entirely from his own stated trading rules. This exploration of Livermore's complex and ultimately tragic journey draws upon multiple comprehensive biographies and extensive online news archives, offering a deeper, more nuanced understanding than simpler accounts. While a detailed dive into such a life can be lengthy, the profound lessons embedded within Jesse Livermore's rise and fall make it a story well worth the time and consideration. Jesse Livermore lived a life like a candle burning at both ends, brilliant, and blinding, but destined to flicker out far too soon. He left us with more than just chart patterns. He left a cautionary tale about the cost of genius. His net worth reached the billions, but his self-worth was always tied to the next trade. As you navigate your own financial journey, remember, the goal isn't just to make a fortune, but to be a man or woman who can actually live to enjoy it. Learn from his methods, but more importantly, learn from his mistakes. I have a question for you. If you had made $100 million in a single week, like Livermore did in 1929, would you have had the strength to walk away and protect your peace? Or would you have stayed in the game until there was no way out? Let me know your thoughts in the comments below. Don't forget to like and subscribe for more deep dives into the legends of finance. And until next time, keep your head clear and your risks managed. Goodbye.